The stock market is open today and we do see some fairly mixed results across the board. Do bear in mind the big news this week is Nvidia releasing their earnings after the market closed tomorrow, and today our focus is going to be on 7 stocks politicians have been buying. Now do be aware that under the Stock Act of 2012, US members of Congress need to publicly disclose their stock transactions within 45 days, and we've run through a few of them in fact who have been buying over the last few weeks. We've looked essentially at some of the names they've been buying, what prices, as well as seeing how much they've gone through. And today, as we said, we're going to focus on 7 of them. We're going to have a quick look at each one's historical performance. We're going to touch upon essentially their earnings, whether they beat, whether they miss, and the future projections. And as always, we'll touch very briefly on their dividend safety. We'll talk about dividend yield theory, whether we see an undervaluation signal or in fact possibly a double undervaluation signal. And we'll run through each one, telling you our intrinsic value, how we got there, the margin of safety, 10%, 20, 30%, as well as what Wall Street themselves indicate in terms of upside over the next 12 months. So let's jump straight to it today, which is 3M Company. Now we get 1 buy rating from Wall Street, we get a hold from Seeking Alpha as well as Quant. Now we do know this company right now sits at its 52-week high. It has recently had a dividend cut as well as a spin-off and currently has a forward-looking yield of 2.12% with a forward P just above 18. Now for those that want to know, S&P right now sits around 23, and we do note over the last 12 months very strong, up 51%. Although if you've been a long-term shareholder, you would only be up 9% over the last 10 years, and bear in mind that this doesn't include dividends reinvested, so whilst it would be slightly higher, still a very poor return on the investment, and in fact the all-time highs you'd have to go back, we're talking more than 6 years ago, January 2018, where it was trading at $216. Now bear in mind this company has suffered from litigation which has seen the share price in fact get hammered just over the last few years. Now when we do look back at over the last 4 quarters for 3M shareholders, very nice to note that they have beaten and by quite some distance on the EPS, which does give us faith moving forwards they can hit their targets. Although bear in mind for the next 3 quarters they are anticipating double-digit decreases to the EPS. Quarter 2 though we do see some positivity, although that is around 4 quarters out, and if they hit their next year, so December 2025 EPS estimate, the forward P will come down to around 16.71. Now when we have a quick look, the dividend safety even after the dividend cut does sit at a borderline safe of 50. We do in fact note that was negative 54% cut in May 2024, so just a few months ago, and the current yield does sit around 2.13%. And when we look at dividend yield theory, we do get on the yield itself an overvaluation signal. Bear in mind they did have that recent cut which will skew the data, but typically it tells us a company is undervalued when the current yield sits above the 5-year average. Right now it is lower, 2.13 versus the 5-year 3.86. And we do note another overvaluation signal with the forward P of 17.5 sitting higher than the 14.95 year rolling. So now let's jump into the valuation model, and as always, if you are enjoying the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value in today's episode comes to $126, the average of these 2 models, and typically on this channel when we do our deeper dives we do run through every single one of these models talking about the inputs and outputs. Today we can get straight into it. So first thing to note, the current price sits around $131, so we can see right now 3M does hit marginally higher than our calculated intrinsic value. So whilst on this channel we always like to use a 10% margin of safety, which we execute on if it hits the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. We can in fact see that isn't at that point right now. You need to wait for $113. For those that want to see it 15%, around $107, and at the 20% mark around $100. So right now, as we said, there is no margin of safety if you were to execute on this. In fact, you are paying a little bit of a premium, and Wall Street also agree. Their price target of $133 isn't dissimilar from the current trading price. They see only 2% upside over the next 12 months. But as always, do give us your thoughts in the comments below whether you agree with the price, whether you are buying or in fact selling or even holding. The next stock Congress members are buying is Amazon, where we have a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. This one is trading in the mid to upper end of the 52-week range, a forward P sitting around 37.2, and over the last year it is up around 30%. Over the last 10 years, significant outperformer of the S&P, up 897%. Then when we look at their past earnings, well, again, very strong. Last 4 quarters, they have beaten management targets. And over the next 3, they're anticipating strong double-digit growth. Quarter 2, we have high single-digit at 8%. And if they do hit that earnings per share estimate in December 2025, the forward P will come to around 30.4. Now, they don't currently pay a dividend, so there is no dividend safety to discuss. So for Amazon, we can jump straight into its intrinsic value, which we have around $226. Not too dissimilar from Wall Street. Their price target over the next year, 223, indicating 28% upside. Now, how we got to this, we solely use the DCF model, and as we can see here, we have the free cash flow year on year. Average growth rate fairly skewed, as we can see it goes from a negative to a positive, but moving forwards we do have 3 different rates, a low, medium and high. We've gone for the medium of 20%. Now using this with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see here, the 226, which does indicate 30% upside. Now if you believe that is a little bit too optimistic, well, at the 50% level mark, we can in fact see 159 at the intrinsic value, which does imply 9% downside. And for those that believe actually that is way too low, 25% maybe a little bit more appropriate, we can see the 83% 319 intrinsic value. Now, we are going to take through the 20% as we did just discuss, but as always, these numbers are fairly subjective, and you can grab a copy of this model by clicking on the pinned comment below, where you can run your own numbers through, whether that's for Amazon or any others. So with the intrinsic value at 226, we always use that 10% at the starting point, as we mentioned, and that would be a buy at $204, at the 15% around 192, and then we keep going till it's near that current trading price. And in today's episode, we see not at the 25% level just yet, not too far off, that would be the 170 mark, but you are getting at least a 20% MOS for what we do believe to be a very high quality company over the long term as well. We do see this bond continuing to outperform the S&P. As always, do give us your thoughts below. Just to let you know, we have released our latest free weekly article where we also do an in-depth dive of 3 undervalued stocks with incredible growth rates, double digit every single year. If you want access to this or any other articles completely free, do click on that pinned comment below where you can sign up and read straight away. And we have also released our 35 undervalued stocks for this month for your consideration. We talk through each one, 35 of them in fact, and discuss which ones are in our portfolio. We do drop one every single month, so make sure you are signed up for the September one, which will drop next Monday. The next stock for members of Congress that are buying is FedEx Corporation, where we get the double buy rating from Seeking Alpha from Wall Street, a hold from Quant. This one does trade at the mid to upper end of the 52-week range with a yield of 1.9% and a forward P sitting just above 14. Over the last year, up around 14%. Over the last 10 years, up around 92%. And when we look at their latest earnings, well, they have a 75% track record, 3 out of the last 4. And moving forwards, they are anticipating some very good growth to the EPS. And ultimately, May 2026, so the second annual report to come, that forward PE will come down to around 12.17. In terms of dividend safety score, well, it sits at 64. It does look to be safe. And we do know a very nice increase just 2 months ago, sitting at 9.5%. As always, we do love them to be at a bare minimum the 4% to keep up in line with inflation, although ideally around the double-digit mark, which we can see is fairly near for FedEx. In terms of dividend yield theory, where we get a reasonable valuation signal, the yield not far off the 5-year, and the same to be said for the forward P, 13.9 currently versus the 13 of the 5-year rolling. And when we jump into the valuation, well, our $317 intrinsic value mark isn't dissimilar from Wall Street, a little bit higher, 323 over the next year. They see 10% upside, and when we put a 10% margin of safety as the starting point, we see it isn't quite there yet. So ultimately for FedEx, we only see a 5% MOS, probably one that we wouldn't buy right now, definitely not at the appropriate level. We would want to see at least a 20% MOS, and we can see as well Wall Street don't see too much upside moving forwards. But if you disagree or have any other opinions, do let us know. We have in fact covered UPS in a previous episode, which we do believe, if you want a company out of the two right now on valuation, does look to be the better value buy. The next stock we have from members of Congress is Intel. Now this one was hammered very recently. They in fact stopped the dividend. We have a triple hold right across the board. We have looked at this in detail if you want an in-depth understanding of the movements. Now we do note it is trading right there towards its 52-week low. Over the last year, down 40%. Over the last 10 years, probably one of the worst investments, down 43%. So you would have lost a significant amount of money if you invested 10 years ago. And in fact, if you incorporated inflation, it would be a lot lower. Now in terms of their earnings, well, they did beat 3 out of the last 4. Unfortunately, the more recent one of negative 0.08 cents miss was a very big one. Do again take a look at our in-depth dive if you are interested in investing in this company. And we do know next year that forward P will be sitting around 16.5 if they can hit that 1.22 earnings per share. Now they don't pay a dividend at the moment, as we mentioned, therefore jumping straight into their valuation. What we do note, our intrinsic value of $27 is pretty much in line with Wall Street. Now they do see upside of 37%, and when we do run it through the MOS, there is a fairly large number at the 10% level, a buy at $24, at 15% around 23, at 20% around 21.62, and in today's episode you are getting at least a 25% margin of safety. However, this isn't one that we personally would look to buy. We said every investor will have their own thoughts. The next one they've been buying is Yum China Holdings, where we get another strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. This one is trading in the lower end of the 52-week range with a forward yield of 1.91% and a forward P just above 15. Over the last year, well, down 37%, and over the last 5 years, negative 21%. Again, not the greatest if this has been one you have been holding for quite some time. And then when we take a look at their latest earnings, well, they did in fact beat by around 9 cents. The last 3, we again notice a 75% track record, although the miss was around 4 quarters ago, Q3 2023. And if they do hopefully hit that EPS estimate, forward P will come down to around 13.75. In terms of dividend safety, well, we do have a 60 borderline safe. Very nice, however, to note that increase this year of 23%. Very good. And the average it has increased over the last few years does sit at 4%. This one was one of those outliers at a very favorable rate. And we can see a mass undervaluation signal, 1.91 versus 0.98. And again, another undervaluation, so double today for Yum China Holdings, 14.4. In fact, significantly lower than the 29.6 that we are seeing there on the 5-year rolling. In terms of intrinsic value, well, around $48 is what we see. That is also what Wall Street see in terms of upside. Remember, we did have that strong buy rating from Wall Street, where they do note 44% upside. And in terms of the MOS, well, quite a nice one today. 10% a buy up to $43, at 20% around 38, and at the 30% level we can in fact see right there around the current trading price. So definitely one to consider if you do like the longevity of this company. But as always, if any of these you would like a deeper dive, do let us know below. So in conclusion, for YUMC we get a 30% MOS with 44% upside. This then takes us on to Abbott Laboratories, where we get a double buy with the hold from Quant. This one is trading in the mid to upper end of the 52-week range, a forward yield just below 2%, and a forward P at 24, not dissimilar from the S&P, up around 10% over the last 12 months, and over the last 10 years, an outperformer of the S&P, up 167%, although we can see all-time highs December 2021 at $141. Now, very nice to note, they have at least beat or been in line over the last 4 quarters, and moving forwards, we are seeing positivity. In fact, 3 of the next 4 double-digit EPS growth, with that essential forward P coming down to around 21.93 in December 2025. We also note a first very safe dividend score of 90, and also a very respectable high single-digit increase of 7.8% in December last year. And when we take a look at dividend yield theory, again, another double undervaluation signal, both on the yield as well as the forward PE. Now, when we run this through the valuation model, well, our intrinsic value of $130, a little bit higher than Wall Street's 128, they see 13% upside, And when we put it through the MOS calculation, at 10% a buy at 117, at 15% not quite there yet but not far off, so a near 15% margin of safety with 13% upside for Abbott Laboratories. We then finally get onto advanced micro devices where we get a double buy and a hold from Quant. This one trades in the mid to low end of the 52-week range, a forward P of around 44.4, doesn't currently pay a dividend over the last 12 months, up 46%. Over the last 10 years, a mass outperform of the S&P, up 3,506%. And when we do look at their latest earnings, again, at a minimum, they have been in line over the last 4 quarters. So that is a very good track record. And moving forwards, some incredible double-digit growth quarter on quarter. And that forward P, which does look very high, will come down to around 27.7 next year. In terms of the valuation for AMD, well, our intrinsic value of 189 is pretty much in line with Wall Street. They see $191 with 27% upside. Now, how we got to this intrinsic value, we run it through the DCF model. What we can see here is we've used the 30%. Now we have a low, medium, and high. Now remember that the essential industry for AI is going to be increasing around 45% according to Bloomberg, PwC, and many other articles. Now this really depends on whether or not you believe that moving forwards. We have used what we would consider to be lower than that rate, 25, 30, 35. If you do believe 25% is the more appropriate rate, well, the value will be around 142. So we see around 5% downside, 30% around 26% upside, and 35 around 251, giving that 67%. As always, you can grab a copy of this model, run your own numbers. Again, if it's for AMD or any others, you can use the rates that you do believe are more appropriate. So in terms of the intrinsic value, then the MOS at 10% does indicate a buy at $170. At 15% around 161, and at the 20% level right there where it currently is trading for. So this also tells us Wall Street believe they will be able to continue to increase this essentially at this 30% rate, because that is what we currently have as the intrinsic value. As always, if you did enjoy today's episode, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to sign up to the free weekly newsletter. We will be dropping September's buy list, in fact, next Monday. And as always, come join us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.